Welcome back, everyone, to the Deep Dive. Today, we are going to take a deep dive into something that I think could be really tough to wrap your head around. We're talking about IAS 36, Impairment of Assets.
Yeah.
And this standard, it really is kind of like a window into how companies make sure the value of their assets are really what their books say they are.
Right.
Everything from, machinery to patents to even things like Goodwill.
Exactly. And I think the easiest way to think about impairment is like this. It's basically a reality check for a company's balance sheet.
Okay, I like that.
So when you have an asset,
Yeah.
and that asset's future earning potential or its market value drops below what's recorded on the books as its value, that's when you have to apply the rules of IAS 36.
Got it.
And this doesn't just apply to tangible assets like a building. It also
Yeah.
applies to intangible assets like brand names, intellectual property, and even that figure we hear so much about, Goodwill.
Goodwill, right.
Yeah.
So to get a good grasp on all of this, we went and got all the best sources. We pulled excerpts straight from IAS 36, practical guides on how companies are actually using this stuff, academic research on how transparent companies are being, and even some interesting perspectives on how things could be better when it comes to goodwill impairment. So no matter how familiar you are with this stuff, we want you to leave today with a solid understanding of the core ideas, the real-world problems companies face, and the key information they need to be sharing.
Absolutely.
So let's get down to it.
Let's jump right in.
What's the core of all this?
Well, the core is comparing an asset's recoverable amount
Okay.
to its carrying amount. Now, carrying amount, that's just the asset's value on the balance sheet after depreciation, amortization, and any previous impairment losses.
Right, so basically the book value.
Exactly.
But recoverable amount, that sounds more complex.
It is a bit more involved. Yeah, basically you have to figure out which is higher. The fair value, less costs of disposal, or the value in use.
Okay, so two different ways of looking at it.
Right. Fair value, less costs of disposal.
Yeah.
Imagine you wanted to sell that asset today. What price could you get minus all the costs of selling it?
Okay, so if we're talking about some piece of specialized equipment, we'd be looking at things like auctioneer fees, maybe costs to prep the equipment, shipping costs, all that.
Exactly.
But we're not talking about a fire sale.
Right.
Unless that's the only option.
Right. We're talking about a normal sale under normal conditions.
Got it. And then what about value in use?
Well, value in use is all about the future. It's the total cash flows that asset is expected to generate for the company from using it until they get rid of it.
Okay, so that's where forecasting and estimating come in.
Exactly.
How do you even start to calculate that?
Well, first you estimate all the future cash flows.
Okay.
Inflows and outflows. So that's revenue, costs to operate the asset, and any cash flow you get when you finally dispose of it.
Right. Everything.
Yeah. Then you have to bring those projected cash flows back to their present value. So basically you're saying, what is the value today of all the future cash we expect this asset to generate? But to do that, you need a discount rate.
Okay.
And that discount rate, it has to take into account both the time value of money, the idea that money today is worth more than money tomorrow.
Right.
And the risk that the asset might not actually achieve those projected cash flows.
So you're factoring in the risk that things might not go as planned.
Exactly.
Okay. So an impairment loss only happens when the carrying amount,
Yes.
the book value, is higher than the recoverable amount.
Yes. When the carrying amount is higher than the higher of those two, either fair value, less costs of disposal, or value in use.
Okay, got it. But what if you can't really evaluate an asset on its own? What if it's part of something bigger?
That is a great question, and this is something that I think trips people up a lot.
Yeah, sounds like it is.
Sometimes an asset doesn't generate cash flows all by itself. Think about a piece of software that's used for an entire online sales platform. You can't separate the software from the whole e-commerce operation.
Makes sense.
So in those cases, IAS 36 says you have to look at what's called a cash generating unit, or CGU.
CGU, okay. So how do you define what a CGU is?
Well, a CGU is the smallest group of assets that generate cash flows that are largely independent
Okay.
from other assets or groups of assets. It all comes down to largely independent.
So a single restaurant in a big chain might be a CGU because its money coming in and going out is pretty much self-contained.
Exactly.
But a central warehouse that supplies all the restaurants, that wouldn't be a CGU on its own.
Exactly.
Interesting. So then what about corporate assets? Things like a company headquarters, shared research facilities, a brand name.
Yeah, these things contribute to the cash flows of multiple CGUs, but they don't really generate cash flows on their own.
Right, so you wouldn't test the headquarters building for impairment in isolation.
Right. So the standard says that if you can allocate a portion of the carrying amount of those corporate assets to individual CGUs, then you include that allocated amount when you test the CGUs for impairment.
Okay, so you could allocate the cost of a central IT system based on how much each CGU uses it.
Exactly. But if you can't find a reasonable way to allocate it, like, say, the value of a global brand name, then you do it a bit differently.
Okay.
You first test the individual CGUs on their own,
Hmm.
and if there are any impairment losses, you recognize them.
Yeah.
And then you test the entire group of CGUs that benefit from that corporate asset, and this time you include the carrying amount of the corporate asset itself.
Okay, so test individually and then test the bigger picture.
Right. It makes sure those shared resources get considered in the impairment assessment.
Okay. So now, Goodwill. That one always seems to cause a lot of confusion.
It does, yeah. Goodwill is unique under IAS 36.
Okay.
Goodwill arises when a company acquires another company for more than the fair value of its identifiable net assets.
Right.
And unlike other intangible assets, goodwill is not amortized. That means it doesn't get systematically written down over time.
Okay.
It has to be tested for impairment at least once every year.
At least once a year.
Yeah.
And this all ties back into CGUs, right?
Yes, it does. When goodwill is recorded from an acquisition, it's allocated to the CGUs that are expected to benefit from that acquisition.
Okay.
And this is done at the lowest level that goodwill is monitored for internal management purposes. But it can't be larger than an operating segment.
So this allocation and how you define the CGU, it seems like there's a lot of judgment involved there.
You're absolutely right. There's a lot of judgment involved, and it can have a big impact on whether impairment is recognized.
Right. I see. And when you're testing a CGU that includes goodwill, is there a specific order you follow?
Yes, there is. If a CGU has goodwill, any other assets in that CGU have to be tested for impairment first.
Got it.
And any losses on those other assets, those are recognized before you even think about the goodwill. It's like you're making sure those underlying assets are valued correctly before you look at the goodwill.
Makes sense.
And another thing to remember about goodwill impairment, any loss on goodwill can never be reversed.
Never.
Yeah.
Never. Even if things get better later on, that goodwill impairment stays there.
Okay, that's important to remember. Different from other assets.
That's right.
What about intangible assets other than goodwill?
Well, there are some that are treated similarly to goodwill,
Okay.
like intangible assets with indefinite useful lives. Think of strong brand names or perpetual licenses.
Right, things that could last forever.
Exactly. And also intangible assets that aren't being used yet.
Okay.
These are tested for impairment at least annually,
Mm-hmm.
and also whenever there's an indication that they might be impaired.
Okay, so similar to goodwill.
Right. But for all the other assets that fall under IAS 36, they're only tested for impairment when there's a trigger.
Okay, so when there's a sign that their value might have dropped, so what kind of things would trigger an impairment test? What are the red flags?
There are internal and external triggers. Internally, it could be that an asset is becoming obsolete or it's been damaged.
Makes sense.
Or maybe the way the company uses the asset has changed, or they plan to sell it sooner than expected.
Okay.
Or maybe internal reports show that the asset isn't performing as well as they thought it would.
Right, all internal signs.
Yeah. External triggers could be a drop in the asset's market value.
Okay.
Or maybe there are bad changes in the technology, the market, the economy, or even the legal environment where the asset is used.
So like if a competitor makes a big technological breakthrough, that could trigger an impairment test for a company's existing technology.
Exactly.
Interesting. And then an increase in interest rates could also be a trigger.
Yes, because that can affect the discount rate used in the value in use calculation.
Right, because a higher discount rate means the present value of future cash flows is lower.
Exactly. And different industries have different risks. Like in technology, things become obsolete so fast that impairment reviews happen often.
Makes sense. So let's get back to value and use for a minute. What are the rules around cash flow projections?
Well, they have to be reasonable and supportable.
Okay.
And reflect management's best estimate of future economic conditions with more weight given to external evidence.
So they can't just make up whatever numbers they want.
Right. They usually base these projections on the most recent budgets and forecasts.
Uh-huh.
And they generally don't go beyond 5 years unless there's a good reason for a longer forecast.
5 years seems like a reasonable time frame considering how uncertain things can be.
Right. It's about being realistic.
What about after those 5 years? What happens then?
After that initial 5 years, companies have to extrapolate the cash flows using a steady or declining growth rate.
Okay.
But that rate can't be higher than the long-term average growth rate for the industry or the overall economic growth rate for the country unless they can justify a higher rate.
So again, trying to avoid overly optimistic assumptions.
Exactly.
And what about the cash flows themselves? What should be included and what shouldn't?
Okay, so you can't include cash flows from future restructurings that the company hasn't committed to yet,
Okay.
or from future improvements to the asset. You're basically valuing the asset as it is right now, based on current plans.
Got it.
But you do have to include any cash outflows needed to maintain the asset's current level of performance, like maintenance or necessary upgrades.
Right, to keep things running.
Yes. And if the asset produces something that's used internally by another part of the business, the transfer prices in your calculation should reflect what you could get if you sold it externally.
So you're trying to be realistic about the value of those internal transfers.
Exactly.
What about working capital and inventory?
Well, working capital depends on the situation and how the CGU is defined. You're focusing on operating cash flows, so any changes in working capital that affect those flows should be considered. Inventory is usually dealt with separately under IAS 2, but if a company includes inventory in a CGU for practical reasons, then they have to include the future cash flows from selling that inventory and maybe adjust for gross margins if those are significant.
So it all comes down to being consistent and capturing all the relevant cash flow.
Precisely.
Okay, so now let's talk about the discount rate. You mentioned earlier how important it is.
It is, yeah. It has to be pre-tax, and it has to reflect the market's view of the time value of money and the risks specific to the asset or CGU.
Right, so basically the return that investors would expect for an investment with a similar risk profile.
Exactly.
How do you figure out what that rate is?
Well, you can look at recent market transactions for similar assets, or you can use the weighted average cost of capital, or WACC, of a comparable publicly traded company.
Okay.
But you have to adjust the WACC to reflect any specific risks of the asset or CGU being tested.
Makes sense.
And if you start with a post-tax rate, like you often do with WACC, you have to adjust it to pre-tax.
Okay, that adjustment sounds tricky.
It can be. The standard gives some guidance on how to do it, but it often involves an iterative calculation.
So definitely an area where companies might make mistakes or where analysts should pay close attention.
Absolutely. Okay, so now let's talk about fair value less costs of disposal.
Yep.
It's the price you'd get in a normal sale between knowledgeable, willing parties.
Right.
The best evidence is a recent transaction for the same asset.
Uh-huh.
But if there isn't one, and there's no active market for the asset, then you use the best available information,
Okay.
like recent transactions for similar assets or other valuation techniques.
But again, not a fire sale unless that's the only option.
Right. And you also have to consider the highest and best use of the asset.
What does that mean?
It means you have to think about how a market participant would maximize the asset's value, even if the company isn't using it that way right now.
Okay, so even if a company uses an asset in a certain way, they have to consider if there's a more valuable alternative use. Got it. So what happens when you find an impairment loss? How is that recognized in the financials?
Well, for an individual asset, you just reduce the carrying amount to the recoverable amount.
Okay.
And the difference, that's your impairment loss, which is recognized in profit or loss.
Straight to the P&L.
Yeah, unless the asset was previously revalued upwards, then the loss is treated like a reversal of that revaluation increase.
Interesting.
After the loss is recognized, the new lower carrying amount becomes the asset's new cost basis.
Okay. What about when a CGU is impaired?
That's more complicated. The loss is allocated in a specific order.
Okay.
First, it reduces the carrying amount of any goodwill in that CGU down to 0.
So Goodwill acts like a buffer.
It does, yeah. If the loss is bigger than the goodwill, then the remaining loss is allocated to the other assets in the CGU based on their carrying amounts.
Proportionally.
Exactly. But no asset can be written down below the highest of its own fair value, less costs of disposal, its own value in use, or 0.
Right, so you don't go below its own recoverable value.
Exactly. And any loss on goodwill goes straight to profit or loss and can never be reversed.
Okay, we covered that earlier. So what about reversals for other types of assets?
You can reverse impairment losses on assets other than goodwill.
You can.
Yes, but only if the recoverable amount increases later because of a change in the estimates used.
Okay.
The reversal goes through profit or loss unless the asset is carried at a revalued amount.
And then it goes through other comprehensive income.
Exactly. But the carrying amount can't go above what it would have been if there had never been an impairment loss.
Right, so you can't inflate the value beyond its original trajectory.
Precisely. Now, disclosures are also really important for anyone looking at financial statements.
Yeah, what kind of information should we be looking for?
The disclosures under IAS 36 are meant to be very transparent.
Okay.
They should tell you about the judgments and estimates that management made.
So we can understand how they got to those numbers.
Right. For any asset or CGU where they estimated the recoverable amount, they have to disclose the key assumptions they used, especially those assumptions that have the biggest impact on the recoverable amount.
So if their value in use calculation depends heavily on a certain revenue growth rate, they have to tell us what that rate is.
Exactly. And if the recoverable amount is based on fair value less costs of disposal using present value techniques, they have to disclose every key assumption, the valuation technique, and the discount rates used.
So we can see how they did the valuation and if it makes sense.
Right. And if a small change in a key assumption could change whether there's an impairment or not, they have to disclose that too.
Okay, so like a sensitivity analysis.
Yes. It shows how much uncertainty there is around the impairment assessment.
Got it.
They also have to disclose specific things if some goodwill hasn't been allocated or if they're using a recoverable amount calculation from a previous period.
Okay, so quite a bit of information.
There is, but it's all designed to help people understand the asset values.
Makes sense.
Yeah.
So let's talk about the bigger picture. What are some of the challenges companies face when applying IAS 36?
Well, there's a lot of judgment involved, especially when making long-term forecasts and when there are no observable market prices for assets.
Right, it's not always clear-cut.
No, it's not. And people who use financial statements, regulators, and enforcement bodies, they often have concerns about how rigorous and objective these impairment assessments are,
Okay.
and whether the assumptions are supported by evidence and how transparent the disclosures are.
So there's a lot of room for interpretation.
There is, and things like the discount rate, the cash flow assumptions, and even how you define the CGUs, those can all affect whether you find an impairment or not.
So it's important for companies to apply the standard consistently and avoid generic disclosures that don't mean anything.
Exactly. And there's actually research that shows that the quality of impairment loss recognition can be different in different countries.
Interesting.
Maybe because of differences in regulations and enforcement.
Yeah, that makes sense. So it's been a real deep dive into IAS 36 and impairment.
It has.
Let's sum up the key takeaways for our listeners.
Okay, so basically IAS 36 is about making sure that asset values on the balance sheet don't exceed their recoverable amount.
Yeah.
And that means looking at both fair value less costs of disposal and value in use and using the higher of the two.
Got it.
This whole process involves a lot of estimations and judgment, especially when forecasting cash flows and choosing a discount rate.
Right.
And there are specific rules for different types of assets, like Goodwill, which has to be tested every year, and where impairment losses are never reversed.
Okay.
And the disclosures are crucial for understanding the assumptions and uncertainties involved.
So for anyone analyzing financials, understanding IAS 36 is really important.
It is, yeah.
It's not just about the reported numbers, it's about understanding how they got there.
Mm.
So here's something to think about. Given how subjective these impairment assessments can be, how can we assess the reliability and usefulness of the disclosures we see in company reports? And how might things like changes in interest rates or technological disruptions affect how often and how big impairment losses are in different industries?
Yeah, it's definitely something to think about.
Well, thank you for joining us for this deep dive. Hopefully we've made impairment a little bit easier to understand. Stay tuned for future episodes where we'll continue exploring the world of finance and accounting.